Hello everyone, welcome to Demand Supply Trading Practical Session number 39 for the year 2024. Myself Srijit Kakkar, and today is Sunday 13th of October 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on WhatsApp where we keep updating you regarding our upcoming sessions, or if we have any promotions, or if we have any videos coming up. So in case you're interested in joining this channel, you can scan the QR code which is available on your screen. Otherwise, you will also be able to find the direct link in the description. You can click on that link and you can join this WhatsApp channel. Now, today's session is about practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available 100% free to everyone. So if you have still not learned the methodology, you wish to learn it, the link to the course content is available in the description. Go through the course content, which is the basic lessons, advanced lessons. That will help you understand the complete methodology theoretically. Now, unless and until we take practical examples, at times we don't get a very good understanding of how to apply the complete process, and that is what we do every weekend. So every weekend I do a practical session where I take some examples, and to those examples we apply the complete methodology, which gives you that practical experience of understanding how trades have to be planned using demand supply. And the best part about these sessions is that we are not looking into something which has already happened, because something which has already happened, it's very easy to justify by applying any indicator, any oscillator, right? We can find a number of reasons why would have been a buyer, why we would have been a seller. But planning the trades well in advance, where you would like to buy, where you would like to sell, and then eventually over a period of time, once they get triggered, seeing how the prices they react to these demand and supply areas, they give you much more confidence in the methodology, and that is how you start leaning against this strategy if you have been using something else, right? So this is why I try to do this every weekend so that you can have more practical experience, and the more number of practical examples you'll start seeing, the more your inclination towards will be towards this methodology. Now, before we get started with today's example, we do have some examples from the past which got triggered during this week, and I also got quite a few questions this week, which was because I'm pretty sure all of you would have experienced, the market crashed really, not really, really bad, but yes, we definitely saw a nice downfall in the last, end of the previous week and even at the starting of the of this current week. And that is the time I got a lot of questions that I have been planning trades. Most of my trades, they got stopped out, so I will be touching upon it at the end of the session, right? But looking into the examples which I will be sharing with you will give you that realization that it's not that every trade gets stopped out. And in fact, the examples which I'll show you, you will see not even a single trade got stopped out for us. In fact, some of them are still open trades. Some of them have given us a decent move. Some of them have been exited as break-even trade. But again, I'm following the most conservative approach. If you have an aggressive approach, results can vary. But very good example that if the markets are falling, it's not that every trade will be a stopped out trade. And again, do not assume just because we are doing demand supply, none of the trades will also get stopped out. They will get stopped out, but I'll say, maybe fortunately this time, none of them, they got stopped out. So let's look at those examples, and then we'll start with our example for today's session. So give me a second. Let me bring up the charts. This is the first one. Perfect. So the first one is from session number 24. So this was session number 24. It was an MIT trade for us. We did the analysis for this on the 23rd of June. So if you want to go and watch the previous video, you can do that. You will see when, you'll go through the previous video, the chart will be something like this. We were still not into the zone. And then you can see when the market crashed, we definitely came into the zone, just touched the zone, and that is where we started moving up. Now, first thing is, how's the reward to risk ratio when the prices came back into the zone? If I bring up all demand supply structures, you can see all these areas are tested areas. So if I'm looking for something fresh, I'll have to go further out. And my fresh area of supply is somewhere around here, which is probably showing me a reward to risk ratio that is maybe more like 20:1 or maybe more than that. So reward to risk ratio was not a challenge, but let's say you still want to have some partial profit booking, then you can see even your very first tested quality zone is pretty far away, at least a little over 4 is to 1. So definitely reward to risk ratio was not a challenge, which made it as a tradable opportunity for us. And you can see that market crashed, brought the prices into our demand area. Prices, they just touched the zone. The very next day you had the opportunity to make it as a break even trade, and by the end of the week we were pretty close to 2 is to 1, though we have not yet hit our 2 is to 1 mark. What you can also see here is we have formation of some demand areas as well. Like here you can see we have this drop based rally. So eventually when this supply zone gets violated, we can also trail our stop loss to this demand zone, which is where the worst case scenario will be you'll still get some small profit. Best case scenario, if it continues, we can trail it for bigger targets on this one. So that's the very first example. The session was session number 24. The analysis was done on the 23rd of June, and we got the entry on the 8th of October. All right, let's look at the next example now. The next example is session number 36. So just give me a minute. Let me bring that up. All right, so the next example is session number 36. We did the analysis on the 22nd of September, and you can see prices came into the zone on the 7th of October. Now, this is where we have been trading inside of the zone for the last few days. It hasn't given us the opportunity to make it as a break-even trade. It hasn't even stopped out the zone. You can see our stop loss was a little lower, so we definitely came up a little deeper into the zone, but the zone has not yet been breached. And talking about your reward to risk ratio, now this was also a type 1 trade for us, and the previous one, the one from session number 24 was also a type 1 trade for us if you go through the analysis videos. So now on this chart, if you're looking at your opposing fresh zone, you can see we have a reward to risk ratio which is about 5 is to 1. So that is where you have your nearest opposing zone. So yes, reward to risk ratio is not a challenge. So we'll keep it as an open trade, because as of now, neither the stop loss has been hit, neither we got the opportunity to trail onto it, or maybe even make it as a break even trade. So that's your second example, which is still an open trade, but it's not that because the markets were falling like crazy. We straight away had stopped out trades. So this one is still holding. And now let's look at the last example, and that is from session number 37. So just give me a minute. Let me also bring that up. All right. So the last example is session number 37. We did the analysis on the 29th of September. And again, you can see we came into the zone on the 7th of October. Now, talking about your reward to risk ratio, if I again check mark all demand supply structures, you can see when we came into the zone, this is where we had our nearest zone, but it was tested. This was also tested. Our fresh zone is pretty far away, which is somewhere around here. But now the problem is that once the prices just started moving up, we also had a formation of a new supply area. So now the chart is telling me that if you're looking at your target, you can probably get maybe about 0.2, maybe 0.3, nothing more than that. But once the prices just started moving up, this is where you had your 1 is to 1 mark. So 1 is to 1, you could have made it as a break-even trade, and by the time this candle closed, we would have been out of the trade as a break-even trade. So this would have ended as a break-even trade. Otherwise, the chart was only showing us a very small target, which was achievable the very next day. And that takes care of the last example, which is session number 37. And yes, now that we are done with the review of these trades, so you can see, yes, we did have 3 examples which got triggered, but just because the market was bearish does not mean, all of them, they got stopped out for us. And, this is a question which I got from a lot of people this week, because I know a lot of you might be planning, some long trades, and the crash might have given you a lot of stopped out trades. So we will be touching upon it as we come to the end of the session. That is where, when I take your questions, queries, I'll also touch upon it. But let's get started with our example for today now. So just give me a second. Let me bring up our example for today. All right. Perfect. So yes, whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. If you haven't watched that video yet, do ensure you watch it, and also follow the process that I've explained in that video. Very, very important. right? So yes, because we need to be mechanical and rule based, what we need to do is we need to create something which is called as a trade plan. Now when you're learning trading as a fresher, or even if you're learning a new methodology as a fresher, it's not very easy to create a trade plan from day one. And the reason is you're lacking the experience of that particular strategy. So only once you have good enough experience, it's easy for us to convert it into a mechanical based process. And to overcome this challenge, while you are lacking that experience, I have created a ready-made trade plan for you, which will initially help you in planning trades very mechanically, very rule-based. But as you start having more and more experience, you want to make some modifications to it to make it better suit with your personality style. That can be done. Now, the trade plan is basically combination of two documents. The first one is your trade plan steps. We can call it as the flow chart or the walkthrough, which guides us what we need to do as a demand and supply trader step by step. And all these steps, they have their own elaborate rules, and those elaborate rules are available in the rule book. Again, I'll add, the rule book is a conservative approach. With time, yes, modifications can be done to make it better suit with your personality style. So what is my step number one whenever I start planning trade? Step one is we need to define trade purpose. And what do we mean by trade purpose? Trade purpose implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So the question is, why are we starting with trade purpose as our step number one? And the reason for that is whenever we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is I have so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets like the Indian NSE market, it's not a 24-hour market. I'm pretty sure all of you would have experienced whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you have a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand whenever we hold a position overnight, it has that inherited gap risk, which cannot be avoided. And that is why my recommendation to all of you is initially your hourly dailies should be strictly intraday trades. Don't keep them as overnight trades, because that increases the gap risk. For weekly monthlies, anyhow, you're not expecting to get the exit the same day. So here you have no choice. You'll have to keep those positions as overnight positions. But with time, with experience, if you want to include daily incomes into overnight trades, that can be done. But remember, just because you're doing weekly monthlies does not mean you cannot have gap against you. It can still happen, but since you're leaning against some bigger time frames, the probability definitely reduces. So again, step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. Now, demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is for trend. Lower time frame is the time frame where we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And the answer is in this table. Now mind it, this table which is on page number 31 is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes during the day. So as a monthly income trader, because I'm taking the example from NSE, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Daily will be the lower time frame. That is where we get our ACTS from. And in case I need to use the refining time frame will be the 60 minutes chart. Now, if you're trading markets which are open for longer durations, like commodities, cryptos, Forex, then you can look at the table which is on page number 32 and you can use these time frames. But since we are taking example of NSE, I'll be sticking to these time frames. So coming back, step number 1, I have decided my trade purpose, and from that table I got to know what time frames I'm using. Plus, I also know what is the purpose of each and every time frame. My challenge number 1 is taken care. Now, the next challenge is, yes, I do know my time frames, but on the NSE exchange, I have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need to do now is I need to have a process in place for selecting scripts. So from this big enough list, I have to get a smaller list, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every other day, it's not an easy task. So now the question is, how do I get this smaller list? For this, we use certain computer programs which are called as scanners or screeners. And the way these scanner screeners, they basically work is that we input certain conditions into them. That these are the conditions I'm looking for. And then these scanner screeners identify that out of these a number of symbols, which symbols they match with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, a few examples of these scanner screeners. Example 1. If you go to my website, you will see under the free tab, I have created some scanners for you, which are based on moving averages. Second example, on my YouTube channel, search for scanner, and you'll be able to find a few scanners based on different logics, different approach. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis as well, which can help you in shortlisting symbols. Similarly, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples, but you're not restricted only to these 3-4 different scanner screeners. So we'll look at few examples before we move ahead. But one very important thing which I would like to add, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols. So do not assume that the scanners are telling you what you need to buy or what you need to sell. Scanners are only helping you get a smaller list. Once you have that list, you'll have to analyze them one by one. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So like I was talking about, that once you go to our website, under the free tab, just give me a second. Right, so under the free tab, you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting about 11 symbols for me, and the short scan is shortlisting 1 symbol for me. Now, very important, just because I'm getting these 11 symbols in the long scan does not mean I'll blindly buy these 11. And similarly, just because I'm getting 1 symbol in the short scan does not mean I'll blindly sell this one. So like I was talking about, the job of the scanner is to give you a smaller list, and now you saw I got a list of 12 symbols. So now I'll have to manually analyze these 12. Out of these 12, whatever matches with my trade plan is an opportunity. Whatever doesn't match with my trade plan has no meaning for me. Now, at times, what can happen is your list can be a very small list, like you can see today, or maybe the scanner might not generate any results because nothing is matching with those conditions. Or even otherwise, if you feel that I need to have a bigger list, because the bigger the list is, the higher is the probability you might be able to find something which is matching with your trade plan. So if you want to make this list bigger, what you need to do is, you can see I've given 5 different conditions. Disable the third one, run the scan again, and now you can see initially it was only giving me 11 symbols, but now it is giving me 126. And if I do the same thing for the short scan, which was only shortlisting 1, now it is shortlisting 10 for me. So from 12, now I'm up to 136 symbols to look into. So 136 is not a very big number. I'll say if you want to analyze it, 45 minutes is more than sufficient. You can easily analyze it in about 45 minutes. But yes, if you feel that you still have a bigger list and you want to further filter it out, you can use different filters. Example can be, I can say I don't want from the cash segment. I only want the ones which get traded in the futures, and now you can see from 126 I'm down to only 41 symbols. So yes, you can use different filters. Plus, if you go to the screener section on this website, you have over 150,000 scanners available on this website. Some are based on fundamental analysis. Then you have your top left, you have based on candlestick patterns, you have range breakouts, you have bullish scan, you have bearish scan, you have intraday bearish, you have intraday bullish, you have your crossovers. So you have a number of scanner screeners available to you based on which you can get your results. And this is example of one website. If you do a Google search, you'll be able to find a number of websites providing you a number of scanner screeners based on which you can shortlist your symbols. So now in this example, you saw we got a list of about 136. Now, once you start analyzing them, few challenges which you'll realize. Challenge number one is you'll realize that majority of the symbols in this list, they don't have a quality demand zone or a supply zone. And if you don't have a quality zone, you can't plan your trade, right? Because to plan a trade, I need a quality area on the lower time frame against which I can lean to participate in a trade. And the second challenge is that even if some of these symbols, they do have quality demand supply areas, they might be far away from the current market price, due to which you'll have a longer waiting period before the prices are back into your zone. And during that waiting period, what can happen is whatever price action develops, it might even disqualify the trade setup for you. So these are some challenges we face when we are shortlisting our symbols based on scanners which are based on either conventional technical analysis or fundamental analysis, because none of them have to do anything with demand and supply. So just because something is getting shortlisted does not guarantee that you'll have a quality area available to you. And to overcome this challenge, I have also created two custom build tools. One is called as the alert service, the other one is called as the screener. Again, remember, these are not call giving or tip giving services. These are also scanner screeners. But the difference is that these two scanner screeners are purely based on demand supply zones. If you want to have more information about them, the walkthrough videos are available in the description. You can go through the description, you can watch those videos and understand it. And I'll just quickly show you what they do so that you have a little basic understanding. For more in depth, you can watch the walkthrough video. So talking about alerts, what alerts basically does is that during the live market, as in when you have formation of demand and supply areas, it keeps updating you. And there are two ways you get your alerts. One is we give you some default alerts through our Telegram channel, and the other way is you can also set your custom alerts on TradingView, and based on whatever your custom settings are on TradingView, you'll start getting your notifications via TradingView. And we have demo channel for NSE, MCX and Forex. So here you can see I'm showing you example of NSE demo channel, where on 11th of October, which was Friday, as in when the zones were getting formed, you were getting these notifications. So it gives you the information at what time, on which symbol, what zone has formed, on which time frame, what is the proximal value, what is the distal value. So this is an alert on 5 minutes chart, on the daily time frame, on the 60 minutes chart, on the 5 minutes chart. So you can see as and when these demand and supply areas are getting formed, you keep getting these notifications real time. Now remember, just because you're getting these notifications does not mean you can blindly buy or sell them. This is a screener which is telling you where these zones are getting formed. Once you have that information, you will have to qualify those zones based on your trade plan. And only if they qualify based on your trade plan, they can be your opportunity. So that's your alerts. And the way the screener basically works is that you apply the screener to the chart and you provide your list of a number of symbols. So here you can see I've given a list of 40 symbols, and then I'm telling the screener that out of these 40 symbols, shortlist the symbols for me where my proximity setting is 1%, which means symbols where the current candle is within 1% to a demand area or a supply area, shortlist for me. And it is telling me you have Maruti. So now you can see I don't have to analyze 40 symbols. I know out of these 40 symbols, Maruti is getting closer to the zone. So here you'll see we'll have a demand area. So that is where you have your demand, and you can see the current candle is close to it. Similarly, if I go to Sun Pharma, you'll be having your current candle closer to a demand zone. And that is what you can see here. We are again close to this demand area, and just by a click of a button you can also check it on a different time frame. So now I've shifted to weekly, and now it will give me results based on the weekly demand and supply areas. So this is what your screener does. So again, two tools are available which are purely based on demand supply zones. Alerts, they keep updating you during the live market as and when the zones are getting formed. And screener helps you in identifying symbols where you're getting closer to the zones. You can even change these settings based on if you want to be inside of the zone. That can also be done. So you can make those changes to the screener settings. So yes, choice is yours how you want to get that small list. I showed you a number of ways to do it. Process can be as simple as I don't want to use any of these scanner screeners. I want a small list. I'll only be analyzing my Nifty 50 stocks. Or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that small list. But obviously, the more you are in sync with demand supply, the higher is the probability you might be able to find something which is in sync with your trade plan without going through a very big list of symbols. So, right, you have to make your decision how you want to get that list. Now, once you have that list, you already know your time frames from your step number one. And now you also know what symbols you'll be analyzing. So, you'll have to analyze them one by one. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one was ABC. So we'll have to go to the lower time frame on ABC. Question is, what is my lower time frame? We have the answer from our step number one, that as a monthly income trader, my lower time frame is daily. So I'll go to the daily chart, and this is where I have another exciting news for you. And that exciting news is that we are now providing 100% free 7-day trial of our demand and supply zone indicator. So initially we used to give you access to the demo is still available, but the demo only used to work on one time frame, which is daily, and you could not apply multiple time frame analysis on it. So we were getting a lot of requests from you people that if we can get a trial of the indicator so that we can try it out before we commit to it. So yes, we were working on how we can make it possible for you. So now this is possible. Now how you can get access to the demand and supply zone indicator for 7 days. If you go to the description of this video, you will see that there is a link to a Google form. So you just have to fill that form. It only needs two information. One, your trading view username. So make sure you're providing the correct username. If your username is incorrect, it will not get activated for you. And two, we need just your name. So just fill that form. And once you are done with that form, filling that form, it will get activated for you within 24 hours. And once it gets activated, by default on TradingView, you will receive a notification that the indicator has been activated for you, and then you will be able to try the fully working version of it. And you can try it for 7 days and see how it works for you. Even if you're not doing demand and supply, let's say if you're following some other methodology, you still want to use those demand supply zones as a confluence, right? All those things can be tried out, and that is why we are now helping you make your trading better with making you understand whether the indicator is something which will work for you or it will not work for you, so you can try it out, right? So now, because you will have access to the demand supply zone indicator as a 7 days trial, right? Anyone can use it. And I would also like to add the link which is available in the description. I will highly appreciate if you can also share it with your friends, your family members, if you're on some trading groups, so that more number of people can take advantage of it. They can try it out. Now, coming back to the chart, because like I said, you people will be having access to the indicator at least for 7 days. So let's see what the indicator is telling us. The indicator is telling us that we have a rally-based rally structure, so I don't have to find the zones. The indicator is doing it automatically for me. So step number 3 was to identify a zone, and now we do have a zone available, which is this rally-based rally. So my step number 3 is done. I do have a zone. Just because the zone is available does not mean we can trade it blindly. The next step is to qualify it, for which we'll have a 2-step process. Step 1, we'll qualify it based on the certain conditions, and then we'll qualify it based on the boosters. So the first one is it a case of level on top of level? How do we verify it? Very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is getting divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, you might have a case of level on top of level. But if you don't have a coinciding level, you cannot have a case of level on top of level. So let's verify the zone we have identified. Does it coincide with any intermediate time frame zone? And here you can see on the weekly, we don't have any intermediate time frame zone, which means my zone is not coinciding. And if it is not coinciding, it cannot be a case of level on top of level. So now we know definitely it's not a case of level on top of level. So my very first condition I've already looked into. It's not a case of level on top of level. This is not because of a gap. Therefore, gap rules will also not apply. Pivot non-authenticity not applicable because we only apply pivot non-authenticity to drop-based rallies and rally-based drops. We do not apply to a rally-based rally. And for unstable equilibrium, the leg out should have gone below the basing, which is not happening in this case. Therefore, unstable equilibrium is also not applicable. So if you talk about these conditions, none of these conditions are getting applied. And if they are not getting applied, they cannot disqualify the zone. Only if they get applied, then you have two possibilities, either qualified or disqualified. So in this case, they are not getting applied. Therefore, the zone is qualified for us. Uh, the zone cannot be disqualified unless and until any of these conditions are applicable. So now that we know we have a qualified zone, still we can't trade it blindly. Next step is to do the booster scoring. So the very first one is freshness. We can see the zone is fresh, gets a score of 3. Now talking about strength, I have said this many times that on the daily time frame, even for a single leg out pattern, I use good as my strength. If I change it to explosive, you will see the indicator will not mark it. So we understand that we have a good move, but we don't have an explosive move. And for a good move, I can, oops, just give me a second. Yes, and for a good move, I can definitely give it a score of 1. Now time at the zone, we have again one candle gets a score of 2, and reward to risk ratio will be taking as an assumption. So if you look at the quality, we have a high quality zone, which is a score of 9 out of 10. Let's also draw our entry stop losses and our reward to risk ratio lines. Now coming back to the location, if I go to the monthly time frame, you can see that we do have a demand area, which is right here. But no matter how far back I go, we don't have any supply. And the reason for that is this is where we have our all-time highs. We don't have any data beyond that. So what do we do in such case? We have taken such examples many times in the past, where I talked about, if you think logically, if the prices move down from this pivot high, the only reason for prices to move down has to be some supply, right? It's just that I can't see that supply on this particular time frame, but it might be visible on a different time frame. So if I go to weekly, you can see we don't have any zone on the weekly here. If I go to, let's say, daily, and I change this to all demand supply structures because I want to see all zones, you can see we have a zone a little lower, we don't have a little higher, but it's still, somewhere in that range. Now let me even go to maybe a 4 hours chart, and now you can see we do have a zone exactly where I was talking about. So let's give it a few seconds. Can you see we have a rally based drop structure? So yes, we understand that if prices they move down, definitely there has to be some supply. It's just that that supply is not visible on this particular time frame. So what I can do in such a scenario is, let's say if I'm a very conservative trader, I'll say because I don't have any supply, I can't do my curve analysis. And if I can't do my curve analysis, I'll be skipping this symbol. I'll be moving on to another symbol. That's the most conservative approach. Now, if I am somebody who still wants to plan a trade, I want to make some modifications. That modification can be, yes, I do know I don't have a supply area, but prices, they always go down because of supply. So there has to be some supply on some other time frame. So let me take it as a reference point and draw my curve, which will still help me do the curve analysis, but now dividing it into 4 parts instead of 5, which is very low of the curve, low of the curve, middle of the curve, and high of the curve. Since we don't have a supply zone on the higher time frame, my very high of the curve is missing. So where am I located? I'm planning my trade low on the curve, which is a good location to plan a long trade. So low on the curve gets a score of 1. Now talking about trend, if I go to the weekly time frame, the indicator will automatically do the trend analysis for us, and you can see it is telling us we have 2 supplies violation, which makes it as an uptrend for us. We'll give it a score of 1. Move from the zone, we need at least 4:1, which has not yet happened. So currently it's a score of 0, but if the prices they move up first and then start coming back, this can upgrade to a score of 2. Level on top of level not applicable. Trap is applicable, we'll talk about it, and not a coinciding level. Sorry, 0. So we have a type 2, type 3 trade. Now why it can work like a trap? You'll see if I take a horizontal line wherever the proximal is and start pushing it up, almost here, you can see this area has beautifully worked like resistance, resistance, work like support, working like resistance, working like support, working like support, working like support. So we have a very clean area of support resistance. And now people who believe in support resistance, what they'll be doing is once the prices, let's say they move up and then they start coming back at support, they will buy with their stop losses, which will be sell orders, and those sell orders will be placed below this area. Similarly, if we get a breakout, then the breakout traders will also start selling. So we understand that by the time we enter into this area, we'll have a lot of selling coming into the market, and these people are making two mistakes. Selling after a decline in price means selling at a cheaper price, and in an area where the chart has proven to us that back in history, demand exceeded supply, which is the only reason for prices to move up. So yes, that possibility is there that it might work like a trap. Just give me a second. Right, so that possibility is there that this might work like a trap, for which I've already given it a score of 1. So if you look at the overall scoring, it's a high quality but low probability setup. Therefore, should be done as a type 2, type 3 trade. But in case prices, they move up first and then start coming back, then this will upgrade to a score of 2, thereby converting it into a type 1 trade. So that can happen. It might get, sorry, this is 2, this will remain 0, right? So yes, this might get converted into a type 1 trade if we move up first and then start coming back. Currently, it will remain as a type 2, type 3 trade for us. So going back to our flow chart, yes, we applied our boosters. After applying the boosters, we got to know this should be done as a type 2, type 3 trade. Now, the next thing is, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, you'll have to re-verify, because markets are not static, markets are dynamic, conditions are changing almost every other second. So before placing your order, you'll have to re-verify, does it qualify based on my trade plan? If the answer is yes, you place your order, and once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break-even trade, and after that, if we get the opportunity to trail onto it, we start using our trailing stop loss unless and until we get the exit. So this is how we plan trades, very mechanically, very rule-based, and that takes care of our today's practical example. And yes, before we get into the questions that I have in the chat box, let me add, if these sessions are helping you, I'll highly appreciate if you can hit the thumbs up button and like the video. You can also share it with your friends, family members, if you're on some trading groups, because I know a lot of people, they are struggling with trading. You never know, these videos might help them. And plus, since now we are providing a free 7-day trial of our demand and supply zone indicator, you can also share the link with the fellow traders, so that people can take advantage of it. And yes, now before I get into the questions, let me first start with the question, which I was talking about at the starting of the session, that I got a lot of queries that the market crashed, and a lot of trades, they got stopped out. So the first thing you need to remember is, just because you're doing demand and supply does not mean you'll not have stopped out trades, right? We will definitely have stopped out trades, and it's not just about demand supply. Irrespective what methodology you're using, you will have stopped out trades. So the very first thing you need to understand is, you need to have your risk management rules. So when you went through the course, that is where we talked about, you need to have your daily loss limit. So if you hit that daily loss limit, stop trading for that day, because now you need to understand that today the markets are doing something which is not in sync with your trade plan. So let me take a breather, I'll start trading the next day, right? So you need to respect those your risk management levels, right? So if you have that kind of a loss, close your trading, you're done with it. Now, the second thing you also need to remember is, now when I share trading examples with you, you will see all the trading examples I've shared with you are long trades. Why? Because I only trade in cash, and in the Indian stock market, when you're trading cash, you can only keep a long position overnight. You cannot keep your short positions overnight. So that is my challenge. It does not mean these challenges apply to you as well, right? So just because I'm planning long trades, do not uh, you know do exactly the same thing that you're also only planning long trades, right? If you are, let's say, doing intraday trades, you can plan short trades. If you're trading futures, you can still plan short trades, where if the market went bearish, those short trades would have helped you make a lot of money, right? So my challenge is, I am only restricted to one side of the market. You can participate in both sides, where if the markets were moving down and you would have planned some trades in some supply areas, again, yes, you would have made some good profits on it. And the third thing which you'll also see is, if I talk about myself, every day I go through about 2000 plus companies, and out of which I select my trade examples, right? So can you see, I'm looking at a very big array of symbols, and out of that I just share one with you. So how selective I'm being when I'm sharing these examples with you. So all these factors, they count, and that could be one of the reason, even though the markets were pretty bearish, you saw that none of the trades, they straight away got stopped out. Some of them already gave us a move which is as good as 2:1. Some of them are still hanging around at into the zone. Some of them, they gave us the opportunity to make the trade as a break-even trade, where yes, going with the conservative approach, we are already out of the trade as break-even trade. But this is still much better versus having a lot of stopped-out trades. So yes, you have to understand there are a lot of factors which drive the market, which we cannot control. But what you can control is, one, your risk. What you can control is in which directions you are trading with the market, and next, how selective you are being with planning your trades. So take into consideration these things, and eventually you might feel that yes, if you are paying more focus on these things, the results are not as bad. Obviously, yes, we will have some stopped out trades, but again, I'll add, just because I showed you the three examples and none of them were straight away stopped out trades, do not assume that with demand and supply every trade will be profitable. We will be having stopped out trades, if not this time, maybe the next time, right? But always remember that. All right, so let's see what do we have in the chat box now. The first one is, I am thinking of transition full from Forex to futures, thinking of choosing DIT trade since I am a swing trader, which is WIT. When I check the trades, how do futures, they like confirmation entry. Here is what I mean, using 1 hour as my entry time frame, which is your lower time frame in type 1 trade, or 15 minutes in type 2, type 3. I see them wait price to hit the 1 hour proximal line, and then they move lower time frame. Okay, so what you're basically saying is you want to do type 2, type 3 trades just to have that confirmation. See, there is nothing wrong with it. But what I'll again start with is, whenever I start with a session, I always talk about uh, a video which is how to start trading, where I've explained how you should start with your trading. So irrespective what you're planning in your trade plan, right? Can you see, as if now you're planning that in my trade plan, probably I'll do type 2, type 3 trades, where 1 hour is my lower time frame, and once I see some confirmations on the 15 minutes time frame, then I want to participate and take that trade. Acceptable, right? Now, on the face of it, when you're writing it on a page as a trade plan, it looks fine. But when you start applying it practically, you might face a lot of challenges. One challenge might be, what you might realize is that in case of type 2, type 3 trades, you might be missing a lot of trades. Prices might just be touching your zone and moving away from it, and never give you an opportunity to do it as a type 2, type 3 trade. And that is why I always say that the process that I've explained in that video will help you practically experience it by ensuring that you do not lose a lot of money. But the problem comes, the problem basically comes from that we as a trader, we don't want to give that time. We want to start making money from day one, which is not the right approach. So the first thing is, if you have created a trade plan, go through a sample size, apply that with the minimum risk, right? That is what I've explained in that video. See how it works for you, and that gives you a better understanding where some modifications might be required. Make those modifications, again do a sample size of another a number of trades, and once you're satisfied with the results, okay, these are the results I'm looking for and I'm pretty close to it, then you can start trading for money. Initially, you have to trade for your skills, and that is the process you'll have to follow. All right, so let's see what do we have next. Leg and wick is being taken into consideration when drawing the level by indicator. Is that correct? How to remove it? See, again, when you talk about marking the zones, let's say if it is a drop based rally or a rally based rally, so I'm just talking about the demand areas. So in case of a drop based rally, yes, we always be taking the leg in as well, because if the leg in is the lowest low, that is where the distal line will go. But in case of a rally based rally, it will not take the leg in, right? So depending upon what kind of structure we are marking on the chart, that is how the indicator will work, and it will work exactly the way the zones should be marked. It is not marking it incorrectly. Okay, if there is a level on top of level, but the intermediate time frame zone is big and the entry zone is in middle, do we need to stretch the entry zone to the bottom of the intermediate time frame, even if it increases our risk from 5% from 5 to 12 to 20? Okay, let me try to understand. So what you're saying is, if there is a case of level on top of level, so let's assume we have an intermediate time frame zone which is dividing into multiple zones on the lower time frame, and now you're saying and the entry zone is in the middle, right? So let's say this is somewhere in the middle. Okay, do we need to stretch the entry zone to the okay, so what you're basically saying is, okay, my entry might be somewhere around here, but do I maybe push my distal line a little over? I personally always do it. But is it something which you should be doing? That completely depends how conservatively or aggressively you want to plan your trades. I have shown such examples many times in the past, and if I see something like this, I know prices can further go down into that intermediate time frame zone, stop me out, and then start going in my favor. So I will always prefer to have my stop loss below the distal line of the intermediate time frame versus just the lower time frame, even if it is making my zone wider. Now the only challenge is if the zone is wider and the reward to risk ratio is missing, then I have no choice but to skip the trade. Okay, if you are marking a DIT, the entry zone in lower time frame zone, when the price return, they touch the DIT zone but not the lower time frame, and the price goes away, does that make our entry zone invalid? See, the entry zone does not become invalid. So what you're basically saying is maybe the higher time frame zone is now already tested. Now, depending upon your trade plan, if you're always using fresh zones on the higher time frame for your curve analysis, now this might not be a valid trade for you. But if you're okay with using a tested area, it might still be valid for you. So it all depends upon your trade plan. Can you say that the indicator uses price action? Can you show an example where is different about the indicator? Okay, yes, the demand and supply zone indicator is purely based on price action. It is not based on boring exciting technique. So like you said, just as an example, if I go with the boring exciting technique, this will also be a boring candle. Probably this will also be a boring candle. This will also be a boring candle. So if I go with boring exciting technique, I might call it as a drop, base, 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 and a rally. But since the indicator is based on price action, it understands I should be taking it as a rally based rally versus taking all these candles as my basing candle. So that is where the difference is. All right. Let's see. When taking type 2 trades, if you get a reward to risk ratio that is 1:3 or more on the lower time frame, then when we move to the refining time frame, realize the zone. Okay, see, now what is going to happen is whenever you go from a bigger time frame to a smaller time frame, majority of the times your reward to risk ratio will always decrease, because on the smaller time frame, the same candle will divide into multiple. I mean, from the lower time frame, when you're going to the refining time frame, the same candle will get divided into multiple candles, which will show you more number of zones, which can lower your reward to risk ratio. So that is why for reward to risk ratio, we never look into the refining time frame. It is always the lower time frame, and at best locations we can also shift it to our intermediate time frame, because that is where your reward to risk ratio might even be better, but not on the refining time frame. All right. uh, there was a boring candle which should be used in the zone, but you're yeah. So I guess I've already answered that, because going with the boring exciting technique. So if you see, if I apply the boring candles, all these candles are boring, which would have made you take, mark this as a drop based rally if you're going with boring exciting methodology. But the demand supply zone indicator is based on price action, not based on boring exciting technique, which tells us it's a rally based rally structure, not a drop based rally structure. So that is the difference. And again, I have said this many, many times, demand and supply zone indicator is much more advanced versus just doing the boring exciting technique. And I've also talked about this many, many times. Boring exciting is just a starting point to start training your eyes. Once your eyes are trained, then you will be leaning more against price action, less against boring exciting. All right, so if there are only leg in and leg out, no basing candle between, can we consider it as well? Absolutely not, right? Why? Because a zone is always made up of three components, which is your leg in, your basing, and your leg out. If any one of the component is missing, it's not a complete zone structure. And if it is not a complete zone structure, it is not a zone for us. Like here, you can see, we just came down, started moving up. It's not a zone, right? So that is why we require complete structures, not just a leg in and a leg out. Some boring candles are very big. Should we consider them as boring candles? So yes, can you see now that's the same example. Now this boring candle is pretty big, and that is the reason the indicator is not taking it as a basing, it is taking it as a leg in, right? So that is where we eventually move on from boring exciting to price action. For marking demand zones on intermediate time frame or higher time frame, should we mark wick to wick or border wick? See, again, the zone always starts from the wick, ends at the wick. How you want to mark it is your personal preference, because every approach has its own pros and cons. I always prefer to mark wick to wick irrespective whatever time frame I'm on, because that is where the zone starts from, and that is where the zone ends. Okay, how to join demo alerts? So if you want to join the demo alerts, like I said, go to the description. You have the link to the walkthrough videos, and that walkthrough videos they completely explain how you can join it. The links are available there, and from there you can just simply click on it and you can join it. Okay, so do one disregard a continuation zone on a trending market that has a very poor move. Example, see again, whenever you're planning your trade, it is always better to lean against quality areas, right? So just because the trend is supporting me, I will personally not use a zone which is not a quality zone. I would always prefer to use zone which is quality, even if the trend is not supporting me, right? And that's my approach. But like I always say, every trader has a different personality style. If you say, okay, the zone is not quality, but I have a positive factor, which is where the trend is supporting me, I would still like to use that zone. Absolutely your call. All right. So, hi Sumit, how are you? I'm seeing you after a very long time, right? I hope your trades are doing well. When re-verifying the trade, what to look for specifically, exactly what we looked for when we did the analysis at the very first point, right? So we'll again have to check the complete thing. Is everything still falling into place? If the answer is yes, it can be an opportunity for us. Can we see the difference between price actions? Yeah, so I just showed you an example of that as well. But I also remember, I specifically did this. Somebody asked me that you need that Excel sheet, which was for creating that random result for reward to risk ratios. So I said, I'll definitely share it the next time. So here you have it in the chat box. You can use this URL to download it, and to refresh it, all you'll have to do is just press the delete button on your keyboard. Just click on any empty cell and then just keep pressing the delete button. Every time you press the delete button, it will get refreshed and give you random results. So that is where you can download it from. So because I already had done this, I thought let me share it, because somebody has been asking it for the last two sessions. I said the next session I'll definitely share it with you. All right, so let's see. In the present example, although there are four basing candles, but we are considering only one basing. So while giving trade score, should we count it? See again, uh, if I am using a method which is boring, exciting technique, because it is not as advanced, I might, mark all these four candles as basing. My zone will also become much wider. But once you start leaning against price action, only one candle is the basing, and that is what the indicator is also telling me. Only one candle is the basing, so my scoring will be based on that one single candle. Okay. Okay, so do one disregard a zone that is beyond risk appetite when doing MIT trade and realize the zone has a very big. See, again, having a very wide zone is not a challenge. Why? Because if you have a wider zone, once you do your position size calculation, your position size will go down. So, just as an example, if I want to take a risk of 100, right, and if my zone is 1 rupee or $1, whatever you might want to say it, wide, then my position size will be 100 shares. But if it is 10, then I'll be doing 10 shares. If it is 50, then I'll be doing 2 shares. So it doesn't matter how wide the zone is, I can still manage my risk by reducing my position size. But the challenge here is when the zones are really wide, reward to risk ratios might not be achievable, right? Good reward to risk ratio. So that is what you'll have to be more careful of, that if my zone is wide, can I still see a good reward to risk ratio or not? Risk can be achieved by modifying your position size. All right, okay, another great live presentation continues to stress the importance of sticking to the rules of the trade. These lessons help you. Absolutely. How to identify price action without boring, exciting indicators. So, see, that is something which only comes with time and experience. So, as you start having more and more experience, your eyes will start getting trained to identify these structures. I'll give you a very simple example. Now, if you I'll give you my example. Now, if I go to my kitchen, there'll be a utensil with the number of spices. Probably I'll not be able to identify one spice from another one. But if I ask my wife, from a distance, she might be able to tell me, okay, this one is black pepper and this one is something else. Right now, how do they know the difference? Maybe from 6 feet far away, which I can't even do when I'm, having that utensil in my hand. The reason is that they have that experience, right? From a distance, they'll know which is what. So that only comes with the experience, and that is why I have given you these two ways of start training your eyes. Basic way is the boring, exciting technique, and once you want to move on to the next step, you can even use the demand supply zone indicator, which can help in training your eyes. And now, like I already said, for a week you can even try it absolutely free, and you can try to understand how the price action is getting marked and identifying the zones for you. All right. Uh, All right, so I'm doing forex. My 1% cannot go beyond this. See again, if you're talking about 1% is your daily loss limit, which you'll have to further divide into multiple trades because you might be getting multiple trades in a day. All right. Uh, how to leave boring candle, boring, exciting candle to price action for exercise. So I'm not able to get your point. How to leave boring, exciting candle to price action. See, the only way is, like I said, if you're saying how to shift from boring, exciting to price action, it will only come with time and experience, right? And that's the only way to go about it. All right, perfect. So that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now the next weekend, next Sunday, most probably. So until then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.